Recently, Medifast reported their Q1 2023 results. And, I wasn't originally going to make a video on this because I pretty much feel that nothing really has changed. But one Patreon by the name of Rob actually asked me to make a video. And, I love the Patreons and I love the people that support this channel. And so I would absolutely do it for you guys. And so in this video, I'm going to do a deep dive of sorts into the results for Medifast of the first quarter of 2023. And so, guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, essentially what we're seeing with Medifast is what we essentially predicted would happen in 2023. So you're just seeing some of that materialize with the results that were released in the quarter. And what exactly am I talking about? Well, let's dive into the results. Well, first of all, you can see that they actually earned $3.67 per share in the quarter. Now, this was way higher than what I thought they would earn. I'm only expecting $8 per share in all of 2023. So, right now they're running ahead of my expectations. And, the question is, why would I expect only $8 per share when they've earned substantially more than that in previous years? And, the thesis that I had going into Medifast is that the consumer is slowing down and you're getting competition from different areas. And so, there is a situation here where the company could be challenged in the coming year at least. And so what exactly am I talking about? Well, let's dive into their press release to learn more. So you can see here, first quarter 2023 revenue actually decreased 16.4% to $350 million from $417 million. Now, this is actually an outperformance to my model that I have on Medifast. And if you haven't seen the model, the exceptional thing about that model is that I'm very bearish on the company, and yet it still is trading much cheaper than even what my bearish valuation suggests that it's worth. So that's kind of a very interesting dynamic, and it's a reason why I'm a shareholder of this company. So full disclosure here, guys, but none of this is a recommendation for you to buy. Keep that in mind. Always make your own investment decisions. And so, I'm forecasting it to decline 25% in 2023. So if, they maintain the 16.4% revenue decline throughout the year, they've actually significantly outperformed my model, which is insane. Now, why is the revenue going down? Well, you have a lower number of active earning Optavia coaches and lower coach productivity. Well, this is just a short way of saying that the customer is going away. And if the customer is purchasing less, then you're just going to have fewer coaches trying to sell the product. And so, you really need to focus on getting the customer back or getting the customer to buy. And I think one of the challenges that you're having is that in a pinched environment, the consumer is not going to be purchasing the same amount of products that they were purchasing when they were less cash strapped. And so, you're seeing that with the coaches. So the total number of independent active earning coaches decreased 8.1% in the quarter compared to the first quarter of last year, and they're earning less. They're making around $5,945 versus $6,536 compared to last year. So that's a 9% decline as well. So you got an 8% decline in coaches and a 9% decline in active earning. And part of that really is something that I called out on a previous video, which is that, if you're experiencing higher costs, can you really pass that on to the consumers? And so, the thought was that you might be able to do so. And I think they thought that they would be able to do that because they did increase prices for their customers. I just suspected that 2023 people were just going to be really pinched. And, weight loss products is an easy way to cut spending. If you're thinking about like what areas would a family cut their spending, if you're spending, $200-300 a month on weight loss products, even if it's not that much, even if it's like $100 a month, it's very easy to cut that in an environment where you're looking to save money. And, you can see that people's savings are dwindling and such. And so I think 2023 is just going to be a bad year. But remember, guys, that this is a company that has no debt. And if you have no debt, you can't go bankrupt. All you can do is have a couple of bad years, which is something that I do expect for this company to experience. Now, is $8 a share on EPS a significantly bad thing? I don't think so. I think they do earn around $8 per share. So, it's not cheap or expensive on a current price to earnings ratio. Maybe they're selling at around $10 per share on a forward price to earnings ratio if the shares are trading at around $80 per share, which is where they are today. But that doesn't necessarily mean that if things pick back up, it doesn't necessarily mean that their earnings per share might not go right to $15 per share. And then, if you purchase the shares at $80 a share, it's a very substantial discount to what its intrinsic value would be in an environment where it recovers. So this is one of those where, like, if you strongly believe that this company has a moat and you believe in the direct coaching model for weight loss, which is something that I absolutely do believe in, I think that there could be an opportunity here. But these guys have some problems to solve. So I think, focusing on customer acquisition is the right thing, and it will drive the other two items below it. And so, I think when the customer goes away, that's when your coaches go away, and you have this downward spiral. You saw this upward spiral for them over the last couple of years. Now you're seeing it go the other way. So not a good time to be a Medifast shareholder. This is definitely troubled waters. And so, they're going to continue to refine their programs to optimize coach compensation and increase coach productivity. All this means is lower profitability for Medifast. And I actually don't think that this is the only place where you're going to have lower profitability from Medifast. I think they're going to try and reduce the price of products for customers as well. So you're giving up margin to the coaches to keep them, and you're giving up margin to the customers to keep them. All that means is that we as shareholders are just going to earn less. Now, the other interesting thing is, I love this. Some of the best creators on YouTube actually have Spanish channels like Mr. Beast, because it's a whole new market that exists in the United States and, of course, in Mexico. And so I like the fact that they're working on their Spanish website and the translation of materials into Spanish for future demographic growth. This is huge, and they need to follow up on this, but this is not going to increase revenue substantially in 2023. This is more of a down the line type of thing. And so, we can see right off the bat, they're not saying it, but you can see it in what they're not saying, because how else do you get to these initiatives without reducing margins? That's all I'm seeing here. And you're going to see more and more clues in their earnings release. So in their customer acquisition initiatives, you can see that I like the fact that they're going to use a personalized approach. Now, because it's a coach-led model, it should already be a sort of like a personalized approach anyways. And so I'm not really sure how they're going to do this even more. Maybe they're just going to put more into the software, because they do have like a hybrid model where it's like a software and coach, or like an app and a coach. So that's interesting. They're going to try and recruit new coaches primarily from the customer base. I like that. I like that there's a plan. They're not just saying we're going to try and recruit new coaches, because the next question I would have is, how are you going to recruit new coaches? They're saying that they're going to do it from their customer base, which makes a lot of sense. Now, here's where you see margins and EPS expected to decline. They're going to try to generate repeat orders and increase long-term retention through incentives. So margins and EPS is, once again, I do expect are going to decline here. Now, when it comes to coach-led training, they're saying here that changing social media algorithms require new strategies to reach customers. All this means is that in this environment, look, the creators like to blame the algorithm for when they're failing, but truthfully, or when their engagement is down, truthfully, the algorithms do what the algorithms do, and what they are meant to do is serve what the customer or the viewer is looking for. It is not a surprise to me that my views overall are down on this channel, because we're no longer in this crazy market where you have everybody and their cousin investing in the stock market. We're, probably in an environment where more and more people are moving away from it, because once again, the consumer's cash pinch. Now, this is something that I've been preparing for since the beginning of this channel, and that's why I created sort of like a subscription model, and I provide more value than most other YouTubers in the value investing space with the tracker and the comps that we have. And I'm just going to keep adding more and more value into the offerings. But, to blame algorithms, that's not exactly what's happening. You need to blame your engagement. And so I think this just means that fewer people are searching for weight loss solutions in the pinched consumer environment, and that makes sense. So how do you get them back? I think you got to focus on results, especially from results of people who've used the program. Now, I'm not saying anything that's out of a blue here. They obviously know this, but this is just weird. This irked me the wrong way. Maybe it's just because I'm a creator, but now they do want to target new demographic segments, geographies, and target adjacent products. I think this is a great move. I don't know how much this helps in 2023, but they're working in the right direction, and so let's see how this plays out for them. But I don't see anything specific for 2023 here, other than they're just gonna take it on the chin in terms of margin. And so here's their key initiatives for 2023. So they're gonna unveil new products, and which will give them more opportunities to earn revenue. So I like that. They're going to build the F4F program, which reduces costs to fund growth initiatives. I need to learn more about this. I'm not really too knowledgeable here. If anybody knows more about this, please let me know in the comments below. I'm going to read through more materials just to figure that out. I think I know what it is. I think they've mentioned it before, but I'm not going to comment on it just yet because I'm probably wrong as usual. Now, when it comes to their goal of 15 times 25, so 15% annual revenue growth and 15% sustainable operating margin by 2025, I don't believe this at all. I'm forecasting 50% of this target at 7.5%, and 2024 I'm forecasting 0% growth. So they're only getting 7.5% growth in 2025. So and also their operating profit margin never reaches 15% in my model by 2025. It reaches maybe 14 afterwards. I can't remember, but I'm being very, very pessimistic or very conservative, I would say, on the way that I'm modeling this company. And I think they have to be a little bit more realistic here, especially considering that we're in a year where the first quarter revenues have declined by 16%. And I'm not moving away from the fact that I think as we get into the fall and winter, things are going to get even worse for this company. And so I don't know for sure, but I'm not going to model that they're only losing 16% revenue. I'm going to model that they're losing 25, and that's still fine because the valuation still makes sense. And so here's their guidance. You can see they made $3.67 in Q1. In Q2 they're forecasting $1.32. So in my opinion, margins are expected to decline as they try and support the top line, and I think you're just going to see more and more of this as the year goes on. Now in 2024, does this mean that the EPS goes even lower? I'm kind of thinking about bringing down the model, but I want to see another quarter or two before I do that. And so it looks like the industry has already done that, or like the investment industry. How else can you justify an $80 per share stock price? But I'm not really ready to do that just yet. And this $250 to $270 million revenue, this would mean that they earned around $600 million in the first half, which is pretty damn good. And it suggests that I think my forecast of around $1.2 million of revenue for fiscal year 2023 is probably right. And so here's the model, and here's that $1.2 million of revenue that I'm forecasting for 2023. Notice that is a 25% decline. Notice also that I'm not forecasting any growth in 2024. They want 15% growth. I'm not forecasting anywhere near that. 2025, I'm forecasting a slight recovery. So, they might outperform this considerably. And then I'm only giving them 7.5% thereafter. Also, their operating profit margin, notice I'm giving them 10, 11, 12, 13, 14, 15, but by 2025 I'm way under their 15% margin, so or their target. And so this model is very, very conservative relative to what they're forecasting. Now, the other elephant in the room is there are weight loss drugs that are now in this market, and so it could be a significant headwind for Medifast. I don't think it's going to be a headwind. I think those drugs have other issues, but I might be alone in my thinking there. But I had to put it here because it is something that's impacting the industry. Now, I've been very negative in this video about Medifast, but once again, I remain a shareholder. I'm still optimistic about the future of the business. Now, I do want to end off with some form of positive news. So notice that their cash and cash equivalents have reached $124 million. And the reason why this is happening is because, once again, this is a business that has no debt. They're a cash generating business. They're just not generating as much cash recently, which is why the stock price is down. But, I could see a $50 million buyback in an environment where the share price is depressed. That's exactly what I would do as a owner of this business. And I hope they become very opportunistic and buy back $50 million of shares at these depressed levels. I really hope they do it. I think it will signal that management is really good at allocating capital. Now, I hope that made sense, and I want to know what you guys think about investing in Medifast. Is this something that you guys are still considering doing? Are you guys out, or are you buying more? I want to know what you guys think. Let me know in the comments below. Now, the other thing is that I just showed you guys a Medifast model. If you want to see the model and the valuation and everything else that comes with it, join us at this $5 a month tier to get access to the tracker, and you'll get access to all my models, including Alibaba, Google, Microsoft, etc. There's over 200 people that are supporting the channel right now, which is what allows me to keep doing what I'm doing. The other thing is, a lot of the Patreons who join at that lower level end up upgrading to the higher level because they get access to the monthly calls, the comps. Right now, I've built a comp on 63 regional banks, and I'm actually going to invest in 2 of them. And I'm also going to be putting on special live courses every month. We've already done live courses. I just did the live course for the comps and spoke about many of the regional banks, which you have access to because I recorded it. But so really consider supporting the channel. Now, the other thing is, I recently released a video on what Charlie Munger thinks about the semiconductor space, and specifically what he thinks about Taiwan Semi and what he thinks about Intel. And if you've missed that video, you can get access to it right here.